Good afternoon and welcome to Market Mondays. My name is Seng Yao and I'm standing in for Telecommunications again today. To start, the elephant in the room that nobody really is talking about is that the US market is not doing that well. Since the beginning of the year, although we have seen markets buying the dips, but in reality, technical indicators have been weakening. US equities haven't exactly rolled over considering that the S&P 500 index is still up 4% this year. However, it is key to note that the S&P 500, Dow, and Nasdaq have all dipped below the 50-day moving average thresholds. Why is this happening? Well, for one, Wall Street is clearly waking up to the potential effect of tariffs on consumers, and we can now see that fear slowly showing up in the consumer sentiment data. If we analyze the performance of the top 20 stocks in S&P 500 on Friday, all are from defensive sectors, consumer staples, utilities, and healthcare. Now, these sectors often perform when economic growth concerns emerge. So, where's the smart money flowing to then? In our opinion, gold, China, and to some extent, Singapore. Well, to start off with, gold is a whisker away from 3,000 US dollar per ounce on strong buying interest from central banks. China tech has been red hot with the Hang Seng Tech Index, which basically tracks the 30 largest tech stocks in Hong Kong. That's basically up 30% year to date. But while much of the interest in this sector has been driven by DeepSeek's breakthrough, what is less obvious is Chinese President Xi Jinping's recent meeting with tech leaders last week, and that included Alibaba's founder Jack Ma. Now, the optics of this meeting is actually quite significant because it signals that Beijing's regulatory crackdown on the sector, which began in 2020, is now probably finally over. Now, that also means Alibaba is probably also back in play. Alibaba also released very strong third quarter results where we saw improvements in e-commerce and the AI businesses. In fact, over a call with investors, its CEO said that in the next 3 years, Alibaba's investment in cloud computing and AI infrastructure are expected to exceed the total investment of the past decade. So there's no wonder that there's so much interest in Alibaba. And if you look at the technicals on Alibaba, which I will show the screen next, the stock has actually broken out of its resistance band. So I'm just quickly going to share my screen at this moment. And as you can see, on my screen, the stock has literally broken out of its resistance band. The key thing to note is that the next resistance level will be at 150, and then subsequently after the 150 level will be at 170. Okay. So I'm just going to stop my screen share at the moment and take the focus of this today's program to Singapore equities. The Monetary Authority of Singapore has issued its first round of recommendations to stimulate domestic equities and to also attract foreign wealth AUM. Now, this portion has actually overtaken Hong Kong's AUM for foreign wealth funds. Family offices and of that included. Singapore has actually overtaken Hong Kong as of 2023. So we first asked Dylan, which we did a pre-recording earlier, how the new measures can boost liquidity for the Singapore stock market and what his top picks are. So with that, let me just cut over the recording at this moment.
Sure. So the MAS Equity Review Group's first set of recommendations have actually been quite strong in our view. There are targeted measures on the demand side as well as on the supply side. On the demand side, a new 5 billion Sing dollar market development fund is to be set up with the mandate to fund managers investing in domestic equities. While this is not the GIC put that many market participants were hoping for, it still signals the government's commitment to domestic equities. The bigger, more impactful recommendation in our view is a redirecting of Singapore's wealth flows to the domestic market. Single family offices going forward will be required to invest $50 million in domestic equities versus a much more broad range of assets that they were allowed to invest before. Last year, there were new 600 SFOs that were established in Singapore. if only 50% get established this year, which is a conservative estimate given all the volatility around the world, this will add $15 billion of new flow to SGX. In the past 5 years, total flows to SGX have averaged just under 10 billion a year. Apart from this, there are tax exemptions and schemes to boost mid-cap research as well on the recommendations. Now, on the supply side, regulatory approaches are to be streamlined to complete IPOs approvals within 6 to 8 weeks by making SGX Regco the sole authority to manage IPOs versus the Regco versus and MAS joint authority before. Also, post-listing, Regco will take a much more disclosure-based approach to regulation from the current uncertain mix of disclosure as well as prescriptive approach that they have adopted. So this will reduce a lot of uncertainty for the list companies as well as for market participants as well. There are additional measures being discussed in terms of a Japan-style requirement for shareholder value creation, driving up retail liquidity, as well as strengthening investor safeguards and protection. Our overall view is that while this may not all be a silver bullet to fix all the structural issues of SGX, and the timing might be a bit late given the fact that you are having a revival in Hong Kong and China as well as some of the regional markets, it is a better place to still be at versus where we were before. In terms of stocks, obviously SGX will be the key beneficiary with higher trading and clearing income as well as listing fees. The banks will also benefit from more IBNA fees as well as brokerage fees. iFast and UOB Kay Hian will also benefit for the same reasons. We also think the REITs will benefit as well as some of the high quality small and mid caps as well. So names like CICT, CLAR, Mint, CSC, Franken, AEM, and ISO team as family office flows may look for a little bit more risk than some of the much more larger investors.
Okay, great. So, we'll be circulating this deck to everybody later. And if there's any interest on the stock names that are flagged on this table, please reach out to your sales reps and they'd be more than happy to basically fish out the report for you. Now, in addition to this list, Wilmar has also released its fourth quarter results last week. And here we'd like to also come back to Dylan to have him give us his views, why he thinks that despite the weaker than expected set of results, Dylan actually sees the stock bottoming out this year, and that this may actually be a great opportunity to accumulate on Wilmar. So let's head back to Dylan right now.
Yeah, so I mean, fourth quarter results disappointed, but we think that is the bottom in terms of, almost 2 years of declines. Within the results, we saw some early signs of positive momentum across all businesses, where there was sequential volumes as well as margin improvements. The food product segment, which sells staples in China as well as other emerging markets, saw a turnaround with volumes rising about 11% year on year. Feed product volumes, which supplies meal to China's hog industry, also saw an increase of 21% year on year for volumes. This is also a bet on China's domestic consumption recovery with expectations of a more muscular stimulus from the Chinese government. China's 4Q GDP was actually better than expected, and our in-house view is that this turnaround will continue into the first quarter. Some of the Trump administration's policies on pushing back biofuel mandates is also actually positive for Wilmar because it will actually drive soybean prices down. This is good for crush margins as input costs fall. Also, the US-China trade war will impact Wilmar less because they are more focused on domestic staples consumption. And if the Chinese government actually increases stimulus to offset some of the export declines, that will also be a benefit. Post results, we've upgraded our earnings by about 4 to 23% to reflect a much more optimistic trajectory of China as well as regional growth. Plus, the company's new capex forecasts are about one-third lower than what we were initially expecting. So they will have a lot more free cash flow available as well. And from a valuation point of view, when you take our new target price of $4.05, it will trade at about 13 times forward PE, which is still a lot lower than its historical long-term average of 15 times. Now, one of the key downsides to watch out for is this corruption case in Indonesia with a nearly 800 million US dollar fine that the public prosecutor is seeking. The company is saying there is no basis for this case and they're contesting the claims. From an ESG standpoint, we want to highlight that Wilmar's governance scores and governance activity over the past decade or so has been actually quite strong and transparent, but this is a risk to watch out for.
Okay, so there you have it on Wilmar. Now let's move on to the tech sector right now. And our next guest speaker is Hussaini. Now, about 2 weeks ago, Grab was in the limelight and the market talk was that it was exploring a merger with Gojek. This event actually led to quite a fair bit of social media chatter, particularly on X. And now that the 4Q results are out, I'm like to basically bring Hussaini onto the show to share with us Grab's latest results. So Hussaini, hi. How did the various businesses for deliveries, mobility, and financial services perform in the last quarter? Hussaini?
Okay. Apologies. Thanks, Engo, and thanks for having me on the show. So yes, Grab had been in the news for some time with regard to its potential merger with Gojek. While we are not privy of any potential or any such discussion, our analysis suggests a significant synergies on the back of M&A. We estimate synergies of around 100 to 200 million USD per year, translating to an NPV of around 2.5 billion in the event Gojek and Grab mergers. Now, moving on to the results. See, Grab results can be put into two buckets. First is that GMV growth in the fourth quarter accelerated to 20% year on year. It was 15% growth in third quarter. So 20% in the fourth quarter is an acceleration. Mobility growth remained firm at more than 20% year-on-year growth, while the food delivery growth accelerated to 19% growth. It was 15% into the third quarter. Company as well is indicating that going into 2025, they expect a firm GMV growth. So overall, the GMV growth was quite strong, and the indications are strong as well. However, on the flip side, incentives increased 27% year on year, and which management indicated that it was linked to new product rollout, and as such is not linked to competition. This kind of bit disappointed the street, the growth in the incentives. Other area which also came a bit of a concern was the 2024 EBITDA outlook of around 440 to 4 around 440 to 470 million USD. Now, management noted that its financial services losses are likely to remain stable, and that is linked to the fact that they are accelerating their loan growth in Malaysia and also underwriting long duration loans, which requires upfront provisioning. And that is the key reason for the financial services losses to remain stable. Management also guided for a higher corporate cost, which is linked to its investments into AI as well as into electric vehicles. So, in our view, net the guidance or the investments are tactical in nature and are not indicative of the broader competition in the market. One last thing to note as far as Grab's guidance is concerned is that management is quite conservative in their guidance. Even in the past, we have seen that they had initially guided on a conservative side, but over the subsequent quarters, they had raised their guidance.
Hussein, can you also talk us through that when we look at Grab's trading patterns on a quarter by quarter basis, are there any seasonality risks to factor in for the next quarter's results?
Yes. So first quarter is likely to be a soft quarter, and it is a seasonally soft quarter, mainly because of the fact that usually first quarter has a lower number of days compared to the fourth quarter. This year it will be two less days, and there is also a Chinese New Year linked factor as well. Okay, and this particularly impact the food delivery side of the business. So yes, first quarter is a seasonally soft quarter. This year particularly, the impact will be bit more stark, and the reason is that this year Hari Raya, the Muslim festive fasting season, will be both in first quarter and second quarter.
Right.
Last year it was just in second quarter, and that also puts some downward pressure on the food delivery side, the Muslim festive season. So combined, these two will have some impact onto the first quarter momentum on a quarter-on-quarter basis, even on a year-on-year basis, because last year Muslim festive season was both in first and second quarter. This year it is predominantly into the first quarter.
Yep.
What management also highlighted is that so far in January, it was quite strong. Their momentum was overall strong. And also noted that going into second quarter, they expect a strong recovery as well.
Okay, great. Thanks very much, Hussein. So I guess the key message is that there's time to accumulate on Grab. We don't need to basically rush into this set of results. Yeah.
Yes.
Okay, great. Let's kind of move over to Singtel right now, which also released third quarter results. Now, Hussein, how did the core business and associates income perform in this quarter?
Yeah, sure. So Singtel overall was quite strong, and we had seen this strong results from Singtel after, I would say, many quarters or many years. So company posted a very strong 22% year-on-year and 16% quarter-on-quarter earnings growth. And it was mainly led by associates, particularly Bharti Airtel in India and AIS in Thailand. And both these markets are doing extremely well, with India seeing some price increases, while Thailand is benefiting from the consolidation of the industry. And we expect these trends, both in India as well as in Thailand, to continue. On the core business of Singtel, it also did better with 6% year-on-year earnings growth. Optus in Australia and NCS, which is its IT services business, stand out. And maybe the last thing to note is that Singtel raised its EBIT guidance from low teens to high teens to low 20% for the full year for FY25. And they also raised associate dividend guidance from $1.1 billion previously to now $1.3 billion. Also, Singtel sharpened its dividend guidance, its own dividend guidance to 16.5 cents, which whereas Street before these results were expecting it to be 15.4 cents. So that also came as a surprise. Now, following the results, we raised our earnings as forecast by 2 to 3% for Singtel, and also raised our target price to $3.72, and we reiterate our buy on Singtel.
Okay, great. So everybody, please keep a watch out on Singtel. I think it's a great opportunity to buy on the stock, given its strong set of results as well as outlook. we've come to the almost to the end of our program for today. But before we end, I'd just like to flag an upcoming event which may be of interest to you. So on the 27th of this month, Maybank will be hosting a conjoint event with our partner Wedbush Securities in US to talk about the US tech sector and basically what's left in terms of upside, right? This program will be hosted by Dylan, and we'll be joined by Dan Eaves, who's a very seasoned tech analyst from Wedbush. So if you can, the QR code is on your screen right now. Please register for this event, and we do sincerely look forward to having you, to talk about the entire sector and where the opportunities might lie. So with that, thank you so much for your time this afternoon. And we look forward to seeing you again next week. Thank you.